Hi, I'm Kyle Boggie, CPA and Tax Director at Nth Degree CPAs. Last year, I had a client who made $800,000 and paid zero federal income tax. Completely legal, no offshore accounts, no sketchy schemes, just one powerful strategy that most high earners have never heard of. What if I told you there's a way to potentially eliminate your entire federal tax bill while building a cash flowing real estate empire? I'm talking about high earners who are taking $300,000, $400,000, even $500,000 in write-offs in the first year alone. At Nth Degree CPAs, we specialize in advanced tax planning strategies for successful business owners and high-income earners. We're not your typical accounting firm that just prepares tax returns. We're strategic tax planners who help our clients legally minimize their tax burden while building their wealth. Today, I'm going to reveal the short-term rental tax loophole that's allowing sophisticated investors to legally flip the tax code upside down. While everyone else is paying Uncle Sam, these people are getting massive checks back from the IRS. This is not tax avoidance. This is weaponizing the tax code exactly as Congress intended. Now, before we dive in, let me be clear about who this strategy is for. You're a growth-focused business owner or high-income earner with at least $400,000 in annual taxable income. You're tired of traditional accounting solutions that just accept high tax bills as inevitable. And you know your money and business should help you live the life that you want. If that sounds like you, then what I'm about to share could be the most valuable information that you hear all year. But first, I need to ask you three essential questions. One, do you want to turn your money into things that have a long-term benefit? Are you willing to learn new things, even if it means changing your mind about what you thought you knew about taxes and real estate? And do you want to learn how to take smart, calculated risks that the wealthy have been using for decades? If you answered yes to those questions, then you're ready to understand why short-term rentals could be your path to massive tax savings. First, let's talk about why traditional rental properties don't work for high-income earners like you. If you own traditional rental properties, you're stuck in what's called the passive loss limitation rules. Here's the brutal reality. Any losses from your rental properties can only be used to offset other passive income, like income from other rentals or limited partnerships. This means your rental losses can't touch your W-2 wages, your business income, or your investment income. For someone making $400,000 a year, this severely limits the tax benefits you can actually use. Those losses just sit there, carrying forward indefinitely, doing nothing to help your current situation. This is why so many high earners get frustrated with real estate. The tax benefits they were promised simply don't materialize. But here's where it gets interesting. There's a specific rule in the tax code that changes everything. It's called the 7-day rule, and it's your gateway to unlimited loss deductions. When your short-term rental has an average stay of 7 days or less, it's no longer considered a passive rental activity. Instead, it becomes a non-passive business activity. Let me say that again because this is crucial. Average stay under 7 days equals non-passive business activity. What does this mean for you? It means you're not subject to passive loss limitations. Your losses can offset any type of income, your W-2 wages, business income, investment income, they're all fair game. There are no AGI phase-outs or income limitations. The magic formula is simple. Total guest days divided by total bookings equals average length of stay. Keep this number under 7 days and you've unlocked the door to massive tax savings. Now, to qualify for these benefits, you need to meet what's called the material participation tests. And there are two main tests that work best for short-term rentals. First, the gold standard, the 500 hours test. You need to participate more than 500 hours during the tax year in your short-term rental activities. This includes management, maintenance, marketing, guest communication, everything that you're doing to support operations. This is the most reliable test and the one that I recommend most that clients focus on. There is an alternative. There's the 100 hours test. You can also qualify for material participation by achieving at least 100 hours of time supporting the business, but no other person can participate more than you do in the operations of the business. Here's a key point that many people miss. If someone else works 105 hours in the business, you only need to reach 105.1 hours. You don't have to jump all the way to 500 hours to qualify. The other thing that's really helpful is you can aggregate your time and a spouse's time for purposes of this test. So if you're married and both you and your spouse are involved in operations, that can help you to drive this number up. Where you need to be careful is if you have property managers or contractors that are doing a significant amount of work on the business activity, you really need to track their time and your time and ensure that your time exceeds theirs if you're going after that 100 hours test. Here's what most people don't realize. The majority of your material participation happens naturally in the first month after closing. You'll typically spend concentrated weeks, sometimes 3 to 5 days straight, setting up the property. This includes coordinating with contractors, making trips to the hardware store, overseeing painting and furnishing, and handling all of the setup details. If you're awake 16 hours a day for 3 to 4 days, and you're spending 10 to 12 hours actively working on the property, you can easily accumulate 30 to 50 hours in a single week. Do this a couple of times, plus all the ongoing management of the business, and you'll easily hit that 100 hours goal. Here's a critical point. These tests apply to each individual property, unless you report your short-term rental enterprise as a single tax reporting group to the IRS. Another pro tip, track everything in real time. Don't try to reconstruct your hours later. That's extremely challenging and risky if you face an IRS audit. Let me be crystal clear about something. Documentation is absolutely critical. The IRS will scrutinize these deductions, especially for high earners. Your documentation should include detailed time logs and activity records, property management software screenshots showing your involvement, travel records for property visits, which are tax deductible, by the way, communication logs with guests and vendors, receipts and records for all property-related expenses. Track everything in real time. Don't wait until tax season to put this together. The IRS expects contemporaneous records, not reconstructed logs. I had a client recently go through an IRS audit on their short-term rental deductions. Because we had detailed calendars, thousands of emails, call logs, and all the documentation that we've discussed here, we were able to provide bulletproof evidence to the IRS. The IRS couldn't argue with the documentation, and we were able to sustain the entire short-term rental loss, creating a massive tax benefit for the client. This is why documentation isn't just recommended, it's your insurance policy. The few extra minutes you spend tracking activities in real time could save you tens of thousands of dollars and countless headaches later. Now let's talk about the real wealth accelerator, bonus depreciation. This is where the strategy becomes truly powerful for high earners. With bonus depreciation, you can write off personal property immediately rather than depreciating it over several years. We're talking about furniture, appliances, technology, decorations, anything with a useful life of less than 20 years. Here's what qualifies. New and used property, as long as it's new to you, personal property with less than a 20-year life, and items that are placed in service during the tax year. Through cost segregation studies, we typically see 25 to 35% of the property's purchase price qualify for bonus depreciation. So on a $1 million property, you're looking at $250,000 to $350,000 in immediate write-offs. But here's something critical about property selection. Not all properties are created equal. The land to building ratio makes a huge difference. Properties in areas where land values are low relative to the structure give you significantly more depreciation opportunity. For example, I've seen clients who work with specialized short-term rental acquisition companies to get about 10 percentage points more depreciation than those who buy properties on their own. That's the difference between a $200,000 first year loss and a $300,000 first year loss on $1 million property, or about $40,000 in additional tax savings. The power of this strategy is incredible. Currently, you can take 40% bonus depreciation in 2024. There are no dollar limitations on bonus depreciation, unlike Section 179 deductions. It applies to your business use percentage of business property. And here's the kicker. They are strongly considering, a return to 100% bonus depreciation in the short term, potentially retroactively effective for all of 2025. Here's a real world example. If you purchase and furnish a $1 million short-term rental and $300,000 of that qualify for bonus depreciation at a 60% rate, that's an immediate $180,000 deduction. At 100% bonus depreciation, that becomes a $300,000 immediate deduction. For someone that's in the 37% tax bracket, that's potentially $111,000 of tax savings from just one property in the first year that it's placed in service. Here's how high earners are strategically implementing this. First, you purchase and set up your short-term rental properties. You want to focus on areas with favorable land to building ratios. Then front load your material participation in that first month after closing. Furnish the property completely with high quality items. Begin operations ensuring that the average stay stays under 7 days. Document everything in real time. And then take a massive bonus depreciation deduction. Ongoing, we get to continue operating with stays under 7 days, maintain detailed time logs and documentation, regularly upgrade and replace furnishings for continued depreciation opportunity, and consider expanding your portfolio systematically. As you add additional properties over the years, you can continue to leverage this strategy for outsized first-year returns. For liability protection and privacy, many investors form LLCs. States like Wyoming and Montana are popular for anonymity and lack of state filing requirements for the LLC itself. However, understand that you'll typically still need to file tax returns in both your home state and the state where the property is located. For tax purposes, these LLCs are usually treated as disregarded entities, meaning they flow through to your personal tax return. Definitely avoid S corporation elections for rental properties. The S corporation doesn't provide the same benefits that it would for a traditional operating business. If you're planning multiple properties, you can group them together for material participation purposes, treating your short-term rental operation like a hotel business with multiple locations. However, be careful about partnerships. If you have multiple non-spouse owners of an LLC, only one person or one couple that is a member in that LLC can claim that 100 hours test. Because again, we have to say we contributed more time than anybody else. So multiple owners only one of them could contribute more time than the others. So generally, we recommend you having sole control when you're going after a strategy like this. Spoke to that a little bit. All right. So for multiple properties, consider a real estate holding company structure with individual LLCs for each property and a management services company off to the side. This can provide additional benefits and liability protection while maintaining your ability to group properties for material participation tests. Here's what this means for you as a high earner. If you're making $400,000 or more annually and paying $120,000 or more in federal taxes, this strategy could potentially reduce that tax liability, in some cases to zero, while building a valuable real estate portfolio. There is one limitation that I didn't mention. It's called the excess business loss rule. For 2025, if you're a single person, you can offset up to $313,000 of non-business income with business losses. If you're married filing a joint return, that limits $626,000. So any excess losses that we have from 2025 that we aren't able to use because we've exceeded those thresholds, those losses will carry forward to 2026 and act just like a standard net operating loss, eligible for complete offset in the following year. If you decide to sell your short-term rental property, even after just 1 year, you'll still generally come out ahead in that scenario. You might get a 37 to 40% tax benefit in the first year, and through something called depreciation recapture, when you sell the property, you might get a clawback on some of that benefit at a rate of between 25 and 35%. But in most cases, you're still going to recognize a 12 to 15 percentage point arbitrage in your favor during that short gap. That said, we generally recommend going after this short-term rental strategy when you're planning to hold a property for at least 5 years. Most of my clients who ask about converting a short-term rental into a long-term rental, they generally find that this makes economic sense when the property is under $500,000 to $550,000 in value. For those above that range, the short-term rental tends to continue to pencil out as the best cash flow approach long-term. A few requirements to keep in mind: average stay under 7 days, material participation of at least 100 hours annually, and the ability to front load that strategy, proper documentation of everything in real time, strategic property selection for maximum depreciation, professional guidance to ensure compliance. This is not a get-rich-quick scheme or a tax shelter. This is strategic use of existing tax law to build wealth while legally minimizing your tax burden. If you're earning $400,000 or more and you're serious about implementing this strategy, you need specialized professional guidance. Here's the reality. Out of roughly 200 million tax returns that are filed annually, only about 100 to 300,000 involve short-term rentals. That's 0.1% of all tax returns. Most CPAs simply don't specialize in this area. You need professionals who understand not just the tax strategy, but also property selection for maximum depreciation, proper documentation systems, state filing requirements, and ongoing compliance. The stakes are too high and the rules are too complex to go it alone or work with generalists. The key is getting started with the right structure, the right property selection criteria, the right documentation systems, and the right ongoing support. Remember, every day you wait is another day you're paying more in taxes than you need to. The wealthy don't pay high tax rates because they know strategies like this exist, and they work with specialists who can help them implement them properly. And now you do too. Thanks.